Hello and welcome to Fidelity Connects, a Fidelity Investments Canada podcast connecting you to the world of investing and helping you stay ahead. Today on the show, we sit down with longtime contrarian investor Hugo Lavallée as he discusses a wide range of topics, including commodities, equities, and how he's managing his climate leadership fund, plus his contrarian style of investing in today's current market environment. Hugo comments on commodities and says he's treating all commodities equally, but he notes he owns more metals than energy. Canadian oil looks better on a relative basis, but unfortunately, the world is shrinking, so to him, it's easier to be positive on metals, specifically copper. He says we need demand to come back on the commodity side, and if we get that cyclical rebound in demand, we will need to pay more attention to commodities. Hugo talks about infrastructure spending and how it's a super bullish trend right now. He touches on telco and says it's a battleground for stocks. For him, he views it as having two ponds. One pond where you can grow your earnings 10% a year, and the other is where you think companies can grow their earnings 15 to 20% a year. Hugo rather dip into that pond. Hugo explains how he looks at stocks and which companies to invest in. He's always following great businesses and something happens to that company. Typically what happens is that margins get crushed and they are under earning. Then he uses the luxury of time which a lot of competitors are not afforded. He adds it's very difficult to have that vision that things will get better over the span of 2 years, but it's that specific setup that he feels differentiates him from others and what he's looking at all the time. This podcast was recorded on June 4th, 2024.
Hi, Hugo. How are you?
Hi, Pamela. How are you? Good morning.
I'm well, thank you. It's great to see you. And we invite everyone who's seeing you here and listening to you here today to send your questions in for Hugo over the next half hour or so. So let's talk a little bit about what it is that, first of all, you love about the certain stocks and companies that you pick. You're a contrarian investor. There are a few quid pro quos you really like to see, as I recall, in a company. What are those?
Well, the perfect setup, it's a great business. Look, everybody wants to buy a great business, great management team, great story, great price. And I think the only real way to do that is when things are not doing well. So we follow a bunch of great businesses, high returns on capital, opportunity to continue to deploy capital at high rates of return, very Warren Buffett-like. And you understand the management team, you understand compensation, you understand incentives. They're aligned with small shareholders or minority shareholders, and then something happens to that business. Sometimes it's a specific company, sometimes whole industry, sometimes pricing's upside down, but typically what happens is margins get crushed, right? So they're under earning versus what they've made in the past. And then, the last thing that's important is you use the concept of time, the luxury of time, which a lot of our competitors are not afforded. They have to own stocks for today, this week, like literally, or this month. And it's very hard for people to say, I think things are tough now, but they'll get better over the next 2-3 years. And just not a lot of people are afforded that luxury in the stock market anymore.
For sure.
And I think that setup is what differentiates me. And that's what I'm looking for all the time.
So what are some of the, we won't spend forever on macro, but what are some of the pieces of the macro story that you're trying to either look to the other side of, or ultimately see how a longer term macro view might shake out different areas of the market for you to invest in? Like what's going to go on here? Is this inflation story going to stick is really my broad question.
Yeah, I think it's hard. Like in the words of Marcus Aurelius, you can choose to not have an opinion and not be burdened by it. I just like to think, I think for me, I think about it a little bit differently. If companies are already struggling, I'll give you some specific examples of industries. Like in the US transportation space, pricing is difficult. There was oversupply of truckers and trucking in the COVID boom of 21, 22, and now we're on the other side of it. And companies are telling us it's the worst pricing cycle since the Great Recession. So that's, it's a hell of a comment, right? So it's the worst pricing cycle in 15 years. Margins are down, pricing is down, and they're under earning. So you don't really need to make a macro call. I mean, they're already telling you that things are difficult. On the consumer side, it's pretty clear. In Canada, we have a consumption problem. Consumption per capita has been down for a year now on a year-over-year basis. In the United States, kind of the lower end consumer is struggling. Companies that cater to that cohort tell us that things are difficult. There are times when things are better. Right now, things are tough. So if you already know your setup, you don't really have to make predictions. You can just think that well, okay, well, I'm not smart enough to predict everything that's going to happen. But I can imagine, it's important to use our imaginations. I can imagine scenarios where it could be, stimulus to that cohort. It could be lower gas prices. It could be lower interest rates. It could be some revenue windfall, whatever. But you can imagine scenarios where things would get better, and that would be good cyclically for the space. So that's more how I do it, Pamela, is to think about, well, it's tough now, but what could happen that could be positive, and then track if some of these positive things could be happening. Right?
Okay. Sorry, go ahead.
No, I was just saying, like, on the consumer side, for example, we know that companies that have like floor inventory, right? And would it be like cars or Sea-Doos or whatever, or snowmobiles, that they're really hoping for lower rates at some point, because they know that it's people are saying, well, the financing's a little bit expensive. So that if that comes at some point, that people will be looking at these stocks as one way to gator some cyclical momentum.
Right, for sure. Okay, so that cyclical story, also extends to things like commodities, which we're talking about a little bit more now, but had been a bit left for dead after the super cycle. With inflation, with some other pieces of the story, the global story, is it time for that cyclical story to come back to bear? Where does that all fit into a cyclical story, the commodities piece of it?
Well, I won't treat all commodities equal. I think metals beat oil personally, because it's a little bit easier in metals to see the lack of supply and investment that we've had. Look what's happened in oil the last 2 days, right? We have basically artificial supply constraint, right? There's no lack of it worldwide. It's really clear in my mind that Canadian oil looks better on a relative basis, as unfortunately the world is shrinking. So where are you going to get your energy from? But when you look at the commodities, I think it's a little bit easier to be more positive on metals. On the copper side, there's all these extra demand factors, AI data centers, onshoring, decarbonization that are creating a demand pull over the next 10 years. On the gold side, there's central banks buying again. So the way I'm positioned is I definitely own more metals than energy. But I think it's an interesting aspect that, we've been in underinvestment over the last 10 years as people have bought other things. And, things are, I'll put in the same bucket as consumer and transport. You need demand to come back on the commodity side. Demand's a little weak right now. But if we get that cyclical rebound in demand, that it's tied to so many things in the stock market, I think we need to pay more attention to commodities, because we're 10 years into a underinvestment on the supply side, and now the world's shrinking again. So where that supply going to come, especially on the metal side, it's something that I think about a lot.
So how are you positioning based on that?
Well, so the fund, I talked about it in Beverly Hills, if the clients heard me speak there, but definitely have more metals than before. I have a little bit more energy than before. Definitely left some room to buy more if there's weakness. But that's one thing that I've changed in the fund. I don't want to be too negative cyclically. Like, we're seeing weakness. There's weakness in China, which is important for copper. There's weakness in the consumer that we've talked about. There's weakness in transportation. Like, there's a lot of weakness, and I don't want to get like too negative. If these cyclicals keep selling off, there's stuff in the fund I can turn around. I have some staples. I have a tiny bit of cash. I have some utilities. I have a little bit of telcos. Like, there's stuff to sell to press on the cyclical trade. But I don't want to get too negative on the cyclical aspect of things. And it's not atypical to see some weakness into the summer like we're seeing right now. The last 2 years, the stock market kind of bottomed in October, and you had a good, nice Q4 rebound. There's no way I'm going to make that prediction, but it's kind of in the back of my head as a PM. Okay, what do I want to do for the summer? Keeping my eye on the prize that I want to maybe add to some cyclicals at some point. Don't want to get too negative. And how do I try to reposition the fund, to try to get ahead over the next 2-3 years?
Fantastic. When we go back into sort of the story of the consumer, the financials are inevitably linked to this, because we know the mortgage story in Canada. We've had the bank earnings. Sort of a strange collection of bank earnings, actually, to be honest. But what do you think of the consumer and therefore the financials? We'll talk about other consumer stocks in a sec.
Yeah, so on the financials, I don't do a ton of financials. I certainly don't do a lot of US financials. I do some Canadian financials. I mean, people know I've owned Onyx now for about a year. It's been good to us. It kind of felt into that camp, that pretty good business, but really positive change happening there with a new CEO. And that's led to some positive change. And the stock was really cheap because people really don't like private equity right now. So that's my biggest position in financials. On the Canadian banks, which I know they're always very topical. I'm underweight all of them. I own 3 of them. It's a little bit hard with financials because you never know. Like, you look at the quarters we just went through. Did the bank make bad loans, or were they more prudent with their PCLs versus others?
Interesting.
So it's a little hard to tell the first quarter. You almost have to let it play through, right? So in a year from now, we'll know, like, some of the banks that were a little bit, took more losses, were they more conservative, or were they actually made worse loans? And it's a little hard to know, to be honest. But it's something that we're really digging deep into. We're talking to them, obviously. We're talking to their chief risk officer to try to get a better sense of what's happening. I think it's hard to tell off the gate, but the market reacts to the quarters, and we're just trying to see if there's an opportunity there.
Yeah, that's sort of what I was going to ask you, if there's an opportunity there, because it was, an interesting collection of earnings in that sense.
Yeah, it's just really hard because it's so fresh. I can't tell you, this bank versus this bank, but I think people can read between the lines. What I'm saying here is we're trying to, there's some bank stocks that went down on earnings and some went up. And it's like, okay, well, are you a better bank or worse bank, or actually were you a little bit more prudent? And we're trying to make sense of that.
So let's go into the consumer discretionary a bit more, because we were talking about that at the very beginning. But this is where you would think, with consumers in a difficult spot for all the reasons that we know, why would you want to be looking there? And is it is it basically valuation? They're looking quite interesting valuation-wise.
Yeah, so one thing that I really like to do is to have a plan. So, one thing I was doing, I think 2 weeks ago, is there was 5 or 6 names that are getting really close to the price that I would buy them. And, you check with the analyst, you check your math, and it's like, okay, well, what price will we buy the stock where we think there's a really opportunity to either double our capital over 3 years, or at least double our capital over 5 years, or maybe go up 40% over 2 years, where we really think we can make a market beating return. And there's a couple of stocks, I think I identified 6 of them, and I think I bought 2 of them, something like that, where, wow, we're getting really, really close.
Right.
And I know the narrative's not really good. There's a lot of things happening. Obviously, in the US, one of the big things happening is shrink, right? So we've seen massive increase in shrink, and shrink is obviously bad to margins. And, it's bad, and shrink is bad. And the companies are trying to fight it off a little bit. And I'm trying to gauge, that's the art part of the job. I don't know what's going to happen, but I know that it's almost, you're getting to a point where in some areas, when stores are forced to close because the shrink is so bad, and there's literally theft from organized crime in the store, it's like, well, how much worse can it get? It can get worse, or maybe it doesn't get better for a while, but it's unsustainable. That's one thing I like to tell our young analysts. If it's unsustainably bad, at some point the arrow is going to start pointing the other way. And that's, it seems it can always get worse, but it seems like shrink in the US store base seems we're getting to that point there. So that's one area that I think about. So there's wonderful business models in the United States as retailers that they've been really affected by shrink, and it's really affected margins, and it does not sound good right now. And that's one thing that I'm keeping back in my mind. Look, these stocks are not like top 5 positions, but they're not small, and they could be bigger. They could be getting bigger. And that's one thing that I think about.
Yeah, well, that's the contrarian in you. It's really fascinating to hear how you're viewing that right now. Okay, a couple of questions rolling in here. So here's one, your perspectives, Hugo, on infrastructure spending. Are there opportunities, investment opportunities for you? Do you like that? Do we call it a trend? It's in the markets.
Yeah, well, I certainly feel like a super trend now. And the one thing, I own some of these stocks, and they're in my top 10. I like them. we're really bullish on the trends. Sometimes I wonder, well, is it contrarian anymore, right? I will just say, without being too specific, that I still really like the trend. We all like it, and it's multifaceted, right? It's onshoring, it's decarbonization, it's reinvesting in our infrastructure, it's investing in our infrastructure because we're getting population growth. I mean, there's all these things, and it's fiscal stimulus. The government likes it, so there's all these things pointing in the right direction there. Some of these stocks have re-rated though, right? So the multiples are not the same as before. So still like it, but I'm not jumping up and down thinking this is my best idea anymore. But there's still, some of them are still my top 10. And we like the trend. I mean, the fundamentals are positive.
There is a question about the telcos. The telcos have a rough go. They have had a very, very rough go. There's lots of different reasons. Some of them swimming in debt, trying to assume past competitors and so on. There's the whole story there. Where do they go from here? Are they contrarian to you?
Well, they can be. Look, you'll have as many different, they're like almost like a battleground stocks nowadays.
Yeah,
right? You'll have as many opinions as there's PMs at Fidelity.
Right.
And there's a guy sitting 20 feet from me that owns a ton of them.
Is that Dan?
Yeah, that's Dan. And I will say, I think they're fine. I don't hate them. I don't own a ton of them. I tend to think that I personally tend to think that they've been over-owned, and people have really liked the dividends. And now there's the fear of having just more competition. And, cyclically, we got to watch population growth as well. Some of them have debt. So when interest rates have risen, it's a little bit tougher. You're hoping for deleveraging. I think they're fine. It's just, I'd rather, if we're going fishing, and there's two ponds, and there's a pond where you can grow your earnings 10% a year, and there's a pond where you think companies can grow their earnings 15, 20% a year. I'd rather fish in the other pond. And what I mean by that is, I think you can get really interesting trades at points of maximum pain in telcos and UTs and REITs, but they can never compound earnings like a Dollarama or a Five Below or a Chipotle, or a Couche-Tard or a Constellation Software. And it's always been my personal opinion and my personal taste to go fish in the other ponds. And and Dan will look at P, and it's been very successful doing that. And some of these stocks look really cheap, and I'll be like, okay, but I'd rather focus my energy on maybe a US retailer where the margins are down because there's stuff in the store, but I know that it's a high return box, so they can grow their earnings faster over time because the ROE is higher. And in the long run, earnings growth can follow ROE. So that's just me. So I don't hate them. I own one of them. It's not my favorite fishing spot, if I can use that analogy.
There's a question about market shrink. I mean, it's just when the market gets smaller, but they want you to explain that.
Well, I'm saying two different things, right? So there's consumer shrink, which is, you thought you had X inventory in your store and you have X negative Y. So that's company specific. That's what I mean by shrink. But I guess if you're talking about market shrink, we're talking about companies, for a while, it felt like the stock market was getting IPOs again, right? In 21, 22. Yeah. And now it's just over. And I've been through that before in my career, right? Where it's like, oh, there's nothing else to buy. Companies are going private. It was like that in 06, 07. And we've had still a great opportunity to buy a bunch of terrific companies that are public, right? So sometimes the problem with public market is there are wonderful companies like maybe OpenAI that are private, or SpaceX that we can have some access to, but generally not the same. What's the advantage of public markets is if you use it right, there's a price on the asset every day. And privates are really good. And, I've done a few privates, even when things are tough, they really try to don't do any down rounds unless they have to, which is tough for a guy like me because I like to buy stuff on the cheap, right? In the public markets, things trade every day. Sometimes the market get irrational. So sometimes you're just presented with beautiful prices on the assets that trade in the stock market. So that's kind of how I think about it.
I want to ask about the different funds that you manage. We'll go into all of them. I think you've said that amidst the fund's climate leadership. What do you mean by that?
So I guess year to date, the fund I'm the proudest about is climate leadership. I'm happy how I'm running the fund. There's been a lot of carnage in renewables over the last year, 2 years, but really last year. And the fund's been able to do okay because we were, from the get-go, we were able to trade some pure thematic purity. Oh, I just want to be so pure. I'm just going to buy like solar inverters and electric cars to buy real established businesses that have a climate tailwind. And we made that choice. And I think you're seeing it now in the return. But I think we've been able to differentiate ourselves from other climate funds because we're really trying to buy above average established businesses, but there's a climate tailwind. So we're going to keep pushing out that fund. I'm really excited about it. So, climate leadership, global fund on that decarbonization trend, Canadian ops, 90% in Canada, Canadian stocks beating other Canadian stocks over time. And on Greater Canada, which is $6 billion, which I guess become my flagship fund, it's really about that contrarian thematic running through mostly North American securities and just trying to compound capital as fast as possible as I can do it.
Fantastic. Just going back to the commodities, a question about, and you work with analysts who do both of these sides of things, but the commodity producers themselves, and then the companies that service the commodity producers. Just tell us a little bit about, I know that it's specific to the stock, but is there a category within the commodity story that you prefer on either the service side or the producer side?
That's a really good question because we talk about this all the time. So thanks for that question. Historically, we're more fans of the companies that service the producers because there's more wonderful businesses in there. So there's wonderful oligopolies, for example, in underground mining equipment and some of these Scandinavian companies, and I own one of them. And these companies are on a high return on capital over the cycle. So historically, we're all more for companies that service them. Part of the issue, and that's part of the reason why I'm positive on the commodities price, is it's hard. It's so expensive nowadays to build a new mine that we're having a little bit of a hard time to see where is that going to come from, what cost of capital are going to use, what IR threshold are going to use, what copper price are going to use, which country you're going to build it into. So I'm trying to say is I do a mix of both. I'm trying to do commodity producers for exposure to today's price and the leverage they get today. I'm also trying to buy better businesses. I would normally only try to buy the better businesses, but I think it's a little hard to be like super bullish on a big CapEx cycle just because it's so hard nowadays with all these issues you're facing. How are you going to produce your electricity? What's your community engagement? Which country are you doing this in? To be like really, 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 really bullish on a big like CapEx cycle, which should lead to higher prices. But that's how I think about it.
So are you holding back a little bit then? It sounds like because there isn't a lot of visibility there.
Well, I'm probably holding a little bit back to just buying the best business, right? Because if you're thinking about mining, for example, I could avoid buying miners and just buy the equipment providers, right? In which, for example, you could say, well, I'm going to sell, I don't own it, but I'm going to buy Caterpillar. Because Caterpillar is a better business over the cycle than, XYZ gold miner in Northern Ontario. But it's hard to see that big CapEx boom. So I'm just trying to mix it up in the funds a little bit.
Question about sort of if there's a slowdown in the economy and the idea of consumer anything, but consumer discretionary particularly, also industrials. If you see a slowdown, it sounds like you're sort of able to look through that because you're looking at valuations. But what do you think on the slowdown, the recessionary story for those industries?
It's a good question I ask myself every day because I am exposed to those sectors. And I think you're seeing it. You're seeing it in Greater Canada, for example, a little bit in the year-to-date results, is I'm not chasing tech and semis and AI or DRAM stocks anymore. And I'm leaning into like the real economy, which is tougher. So it's a good question. I would answer it by, I'm trying to buy quality businesses with good balance sheets that can make it through the cycle. It's also size of bets, right? Not to go all in too quickly, always leave some buffer. I can always switch from more consumer staple stocks to more consumer discretionary. I can always sell some utility and buy more industrials. So it's a really good question. I ask myself that question every day. And that's hopefully where the experience comes in to, even if sometimes you're not on the right trend right away, you've left yourself some room not to be hurt by it too much. But you're trying to keep your eye on the prize. Okay, well, at some point things will get better, and that's where I'm going to make my money versus the market, and that's how I'm thinking about it.
And is that sort of work the same for, hard versus soft landing? Like whatever reason we get these cuts for, which we think will start in the next couple of months in Canada, maybe the next few days. But in any case, I
don't think I said cuts will start in the next few months or next few weeks. But I think it's just
hard landing.
Look, it also depends on it's a market of stocks, right? It also depends on what price the market is. So one thing we do a lot at Fidelity is what's priced in. What are the expectations that are priced in, right? Because we can sit here and talk about a bunch of different scenarios, but remember that we buy stocks, and stocks will have expectations priced into them. So as companies come out and the stock price falls and they start cutting expectations, well, we thought we could do X on this year, but we can't do X. Things are too tough. Expectations are being lowered. And I like low expectations. Pamela, I think you've heard me say, successful investing is like a successful marriage. Low expectations. And, we're looking for low expectations because low expectations are easier to beat. And, it's really what I try to specialize in. So as expectations get lowered and people get more and more negative, it's just a little bit easier for me to say, well, we don't need much now to start beating those low expectations. So we're trying to set the bar low and, because then just like in my personal life, try to set the bar low because then you can easily beat those low expectations. And I think that's how I try to specialize in the stock market.
I love that comparison. So can you remind us again about your climate leadership strategy? Are you considering ESG ratings, for instance? Like how do you go about this? And what is the stock selection process? So it's a big question, but if you can just kind of outline it for us.
Okay, so super quickly, I don't consider it an ESG fund. Not that I'm insensitive to it, but I just want to be clear that I put decarbonization above anything else. For example, I own copper stocks in the climate fund. Now, that on an ESG land, you might say, well, what about societal and other things? But from a climate perspective, I think they make a ton of sense because it's like our only path forward. And if we don't have copper, then there's no chance. We have no chance, right? So I would just say, I just be prudent that I am sensitive to these other metrics, but I will put decarbonization ahead of anything else. And then my stock selection process, think about it, ideal setup, 3 circles, establish good business, a new climate tailwind that we can clearly identify, and ideally a contrarian opportunity. And if those 3 circles intersect in that Venn diagram, that's where I get really excited. So when I talk about transportations, I won't own trucking stocks in the climate fund because that doesn't make any sense to me. But if I can own like some railroad stocks where transportation's transportation's out of favor, pricing's a little bit out of favor, right? They're a derivative of trucking. Over time, they should gain share versus trucking because I think they're 70% less carbon intensive. So you have an established good business, pricing's not great, so margins are a little bit depressed. And that over time you should gain some share versus regular trucking. Those are the kind of setups that I'm looking for in climate leadership.
Fantastic. It's great to speak with you and catch up with you. Thank you, Hugo Lavallée, for joining us here today.
Thanks, everybody. Thanks for the great questions.
Thanks for listening to the Fidelity Connects podcast. If you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/how-to-buy for more information. While visiting fidelity.ca, you can also find information on future live webcasts. And don't forget to follow Fidelity Canada on Twitter and LinkedIn. Thanks again. See you next time. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada, ULC, or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy or endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently, and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments.